Hello and welcome to Long Options, another great webcast from Schwab Coaching. My name is Ben Watson. I'm an education coach and senior manager here at Charles Schwab. I'm joined out there in the chat by my good friend Kevin Horner, who is a 28 going on 29, almost 30-year veteran of the financial markets here. He is out there in the chat to help answer your questions and facilitate the conversation. So be a part of that conversation by chatting in questions you might have along the way. If you're here in the recorded version, we're glad to have you with us as well. Make sure that you leave a comment in the comment section for us. We'll get back to those as quickly as we can. Filling in for Rachel Deschelle here this afternoon, and she'll be back next week. We're right in the middle of our very busy live event season. As a matter of fact, a very busy time for those live events. As a matter of fact, Kevin, Rachel, and I just got back from Denver, Colorado. Actually, Kevin's there in Denver, but doing a technical analysis and option strategies live workshop. Well, I'll give you some more information about that if you want to join us for one of those events as we get into this discussion today. But welcome to all of you. We're glad to have you here with us. Glad also to have our great production staff on board, keeping things up and running. A couple of quick housekeeping items as we get started today, as the VIX seems to be pulling back a little bit, and that gives us rise to some volatility impacts. But just a couple of quick housekeeping items. Remember that everything we talk about is simply for illustrative and educational purposes only. It is not a recommendation of any particular strategy or symbol or account type or anything else. Remember that options carry a high level of risk. They're not suitable for all investors. Make sure that you're aware of the characteristics and risks. Standardize options before considering any option transaction. We're going to be using some technical analysis in this discussion today. Technical analysis is not a guarantee of future success. In fact, it's theoretical, as is every form of analysis. Schwab doesn't recommend the use of any one form of technical analysis as a sole means of investment research. We're going to be using the Thinkorswim desktop software platform, specifically the paper money version of that platform. It is, again, a great learning environment. It is not, however, a guarantee of future success out there in the real world. And there are a lot of things that the paper money platform does well, good learning environment. A lot of things that it does differently than a live trading environment. It does not simulate exactly how orders will get filled in the real world and other elements like that. So as we get into this discussion, we'll point out any of those differences along the way. We're going to talk about long options primarily in this discussion. However, a trader who is short an option, and it's an American style option, has the potential to be assigned that obligation at any time prior to expiration, whether that option is in the money, at the money, or out of the money. It does not matter. Also, remember that past performance no guarantee future results. And as we get into this, there is the possibility of losing money. And in the case of a long option, the entire amount invested in that long option contract. So let's jump over here to the Thinkorswim desktop software platform and take a look at what's going on at the moment. I'm going to pop over really quickly to our index grid and just kind of see what's going on with the indexes this morning, because a couple of people asking the question here, Scott and others, we're seeing this rally higher as a potential turnaround. And it is a bit of a face ripper today. I mean, we're up on the week 2.17%. This is a pretty strong bullish candle on the S&P 500, pretty strong bullish candle on the NASDAQ, up 2.3%, and on the Russell 2000, almost up 2%. So the question is, ultimately, from a technical perspective, Scott, and always, and everyone asking, is where do you confirm? What confirms that? What gives you that evidence or that confidence the price is going to keep going, right? Because you've got a momentum shift in most of these cases. You've got a bounce, like in the Russell 2000 that we're seeing right now. You've got a bounce up off of the 200 period moving average, much like you're seeing in the other two indexes coming close to that 200 period moving average. I don't know. Is it a bull trap? I don't like that idea of a bull trap. I don't like the idea of a bear trap. I don't think that's a trap, because the trap implies that there's some intentionality of that scenario, that the the market is nefarious in some way, and it's not. The market moves the way the market's going to move based on its digestion of inputs and news. It's not nefarious, uh, with certain exceptions. But that being said, a bull trap or a bear trap, maybe the way that you avoid sticking your foot in that trap is you wait for confirmation that it is, in fact, doing what you expect it to do, as opposed to trying to bottom tick or pick the bottom in this scenario. So, some thoughts there. But at the same time that we are starting to see this move occurring, right, in the major market indexes, we can come back over here and we take a look at what's going on in the VIX, and see that volatility index, which is reflective of kind of the overall pricing of options, starting to bleed off again from that 30 handle that it touched a couple of sessions ago. And given the fact that VIX is coming down, and it typically tends to come down very quickly, this is a little bit of a reverse of what we often see in volatility moves that are event driven, even geopolitical tension driven VIX rises, because there's oftentimes a single catalyst that will push the VIX to kind of that panic mode. And we've seen that happen before. And then it bleeds off very quickly. What we've seen really since the end of the year and into the February, March timeframe is kind of a gentle rising of the floor. And you're starting to see that, I think, come to the forefront here. The fact that we're seeing this expansion of volatility and the expansion of the volatility of volatility. As a matter of fact, if we look at VIX versus the volatility of the VIX, we can kind of see what's gone on, right? Let me just move these labels really quickly here. The white line is the volatility of volatility, and the blue line is the VIX itself. So VIX coming down, volatility of volatility coming down. But oftentimes, especially as we start to see these last couple of weeks, we see this big expansion of volatility. We saw big ranges on VIX days. That is starting to come back together a little bit. And so the VIX being a mean reverting instrument, meaning when it's high, it tends to come down. When it's low, it tends to go up, because it's met at either of those extremes by either selling pressure when it's high, meaning there are traders that are coming in and selling options on the SPX, which is what drives the VIX, or they're unwinding hedges when those hedges have become more expensive, meaning they bought put options or they bought call options, and they're now turning around and selling them because the price has gone up. That tends to bring the VIX back down. And when the VIX is low, that means that protection is relatively inexpensive. So institutional investors, retail investors may come in and buy SPX options, both puts and calls, to either speculate or hedge against adverse movement. And they do that more often when the VIX is cheap. They also do it when they panic. And that's why you see those very sharp spikes in the VIX when there is panic afoot. This move in the VIX recently, this rally in the VIX that we've seen since February, is not a panic-driven rise in volatility. This is an overall geopolitical tension. This is hedging. This is that hedging activity. And when that hedging gets up to this level, when you see the VIX get up into this 30 handle, and as a matter of fact, if we were to go back over the course of, say, for instance, a 3-year weekly, you can see that this 30 handle typically tends to be, with one or two very simple exceptions, the carry trade unwind, the liberation day, that 30 level on the VIX tends to be that point at which buying pressure, that high price of those SPX options, tends to be met by some pretty strong selling of those options and an unwinding of those hedges, because those hedges have become expensive. So we're seeing it persist a little bit here. We're seeing that higher implied volatility persist just a little while, but it does seem to be kind of breaking down. Now, what would maybe give us an indication that we're seeing kind of a really strong bleed off in that volatility situation, kind of the structure of the VIX, would be maybe a break below this diagonal trend line that's been in place for the last month or so, and a significant move lower. Now, the reason I'm spending a few minutes here talking about the VIX and talking about volatility is because volatility is one of the trinity of influences on option prices. The other two in that trinity being price movement of the underlying instrument and the passage of time. So, in order of predictability or reliability in terms of being able to maybe suss out what it's likely to do, they go like this in terms of probability of being able to predict. Time, theta, is the easiest to predict because we know with, barring certain existential crises that might arise. Now, that being said, when there's geopolitical tensions, existential crisis probably becomes on the bingo card somewhat, but we know that time is going to pass. So that's the kind of most predictable. Two would be volatility, that when volatility is high, it tends to go down. When volatility is low, it tends to go up, that mean reversion nature. The least predictable, but the biggest influence in an option trade, by far, generally, the biggest influence is directional price movement. So of those three, price, time, or volatility, or let's go in order again. Time, volatility, and price, if we go backwards that way, those are the most to least predictable. So if we're going to be a long option trader, then those are the things that we're going to have to pay attention to in terms of the things that we can at least plan for and to a certain extent, but not really, control, because we have no control once we press the button other than where we press the button to get out. So now that we have that kind of in mind, let's think about the decision-making process in terms of what type of trade we might rate, what type of trade we might put together. So what I'm going to do is I'm going to change my grid here to my single grid, and we'll take a look at a particular instrument here. This is AAPL. I just talked about this a little bit this morning, and I'm looking at a couple of things here. One, I'm going to add a little bit of time here out into the forward horizon. I'm going to add, let's go to 20 bars because I want to see, we might even have to go 30 bars here, apply, and okay. And there's our earnings announcement over the horizon. That is on 4/30, so that's about a month away. Okay. And seeing that over the horizon, that tells me that implied volatility likely to rise into that event. Okay, so we're going to talk about implied volatility. The other thing we're going to talk about here is that passage of time. So if the intent is to stay in a long option trade for a particular length of time, one consideration that some traders have is that they may want to be out of that trade prior to that earnings announcement. So knowing that, looking to be out of the trade prior to that announcement to take advantage of directional movement and to avoid the potential for significant adverse movement if the earnings announcement creates that adverse movement, then some traders may plan to be out of the trade prior to that expiration. So let's choose time first. And so I'm going to go to the trade tab. And I'm going to say, hey, where's my earnings announcement? I know that it is April 30th. So I may be looking, so here's May 1st, that expiration. So what I may be doing then is looking for an expiration date that is falling just before that earnings announcement. Now, that being said, the next thing to think about is that earnings announcement week or even the week prior is very likely to have already elevated implied volatility, with the potential for that to drop maybe ahead of the earnings announcement. So some traders then may go just a little bit beyond and say, look, I'm willing to buy a little bit more time for the sake of being able to have some duration so that I'm not getting caught up against that wall of rapid time decay. and get to that point of being able to then sell that time value back to somebody else. So some traders may now go out, and in this case, and I don't think that this is necessarily even uh, that significant an issue as far as going out to something like the 17 July, 108 days to go until expiration, so that we know that we're going to be past, like well past that April 30th earnings announcement and coming close to the next earnings announcement. But it's not, the intent is not to hold on to the position all the way out to the 17th of July. The intent here is to use that length of time to mitigate somewhat that impact of time decay and allow for the opportunity for the stock to make the move that's expected within that time frame, and then sell that time value back to somebody else at a later date, theoretically, right? Hopefully. So let's look at the chart again here really quickly, and I'm going to just draw a level of support. So now we've got to think, okay, if I'm going to go out about 100 days or so, that's going to incorporate this next earnings announcement. I've got to come up with a directional opinion. And the directional opinion here might very well be, Rachel's price patterns notwithstanding, the fact that this is a head and shoulders type of pattern here, but it's gotten really lumpy over on the right hand side. So we may be seeing a little bit of a bounce here. And if we were to look at something like an RSI or something else that might add some context, we've got a bit of a bullish divergence going on here with implied volatility, or excuse me, not with implied volatility, but with momentum. So momentum picking up as this is kind of going sideways. That would indicate maybe there's a little bit of nibbling going on, and we might see some upward price movement here. So price directional bias in this particular case, bullish, because it's bouncing up off of that support level that's been tested once, twice, three times the support level. So looking for a move higher here. So now directionally, we've got an idea. So now the third thing that we need to look at is implied volatility and put that into context as well. So I'm going to go to the Flask icon here. I'm going to put on my implied volatility study, and we're just going to show that. And we're going to see where implied volatility is. Now, here's the thing. Implied volatility right now is a little bit deceiving. And here's one of the challenges why. We had this big spike in implied volatility back last April on that Liberation Day rally, drop and then rally. So that's kind of skewing this percentile range. What that's doing is it's saying if this is the 52-week high up around 71%, then where this is currently at 32% puts this in a fairly low implied volatility percentile range. So if we go to the trade tab and we come down to the bottom of our option chain and we go to today's option statistics, we see that our current implied volatility percentile is in the 25th percentile, which would suggest that it's in the lower quartile, if you will. And that would suggest that low and rising implied volatility might be working in our favor as a long option trader here. But that's basing where this is off of where this previous high is. So if we were to come back into this chart, and that's where the nature of this chart becomes a little bit handy here. If we were to kind of take this from that same time frame here, and let's kind of go to that start, find where it comes back to that starting point, and we'll just zoom across in this time frame. Now what we see in reality is that implied volatility, rather than being low and rising, in fact, in this particular case, is high and falling. So we're kind of artificially taking the extreme out, that statistical outlier. So it's kind of like dropping the high and low scores of a test, if you will. So now what we see is that implied volatility is moving within a range here of the highest being up here at around 38% and the lowest being down here at around 19%. And we're currently sitting at 32%, which would put us probably up in the 70th percentile or so, given the range that we've narrowed this down to. Now, granted, the absolute, if we were going to just be straight out of the box, 52-week high, 52-week low, we're low. But that was a statistical outlier. So Do you drop the high-low score? I don't know. That's your choice in terms of calculating this. But what I see is that at this point, this implied volatility has been going up, and it's really not gotten down to that kind of crush level post the last earnings announcement. It has stayed relatively elevated. And going into another earnings announcement, it's likely to stay, well, I don't know. If you look at what implied volatility is typically done for Apple over the last couple of announcements, it stayed right into that earnings announcement and then crushed. This one, it kind of crushed a little bit beforehand, but that was going into kind of that retail cycle at the end of the year. So I'm going to consider in this particular case that we've got high and falling implied volatility. So here's what we've got going on now. We've got a longer dated option theoretically that we're going to look at, but we've got high and falling implied volatility. And as Rachel has talked about, and as we've talked about, high and falling implied volatility is a kind of a drag for long options traders. That really is kind of working against us. So how do we mitigate that? Well, there are some choices that we can make, because one of the choices is we go shorter term. But shorter term, we get into faster time decay. Huh. Wow. Now we've got a challenge. Now, it could be a short put position, possibly, but the title of this particular webcast is Trading Long Options. So we can't really go short a put in this context. So we work within the context of what we have at our fingertips, because there are traders out there that don't trade short puts. There are traders out there that only trade long options. So how do we find a long option to match up to this kind of conundrum situation here? So that's where we have to be a little bit more parsimonious, if you will, about where we choose our strike price and our expiration. So let's go back to that trade tab for just a second, and let's kind of talk through this. So we go out to the 108 strike, and we're going to keep Delta, Theta, and Vega. Now you're right, Laura, you could go to a different underlying. And by all means, I have a couple of other examples, but I wanted to put this together because I wanted to illustrate some of the challenges so that we understand that. So remember, the point of these webcasts is not the point of this webcast is not to provide recommendations. The point of this webcast is to teach concepts. And so that's why we're teaching the concept here of how we might mitigate some of this impact. So there's an easy answer. There are easier answers than others in this discussion, because notice what's happening here. We're 108 days out from expiration. And if we were to choose, just say, for instance, the at the money strike. So what I'm going to do is I'm going to reduce the number of strikes that I'm displaying here to like 10 strikes. So 5 up and 5 down, just so that we're staying kind of within this range. We'll go wider in just a minute. But I want to look at this 250 strike, kind of the at the money strike, currently sitting at 253.35, which means that really okay, so maybe closer to that 255, but as the at the money strike, but we'll take the 250 kind of as the at the money call. Because remember, we're bullish on the stock, that bounce up off of the support level. But look at our sensitivities here. So we've got about 60 cents of delta sensitivity, directional sensitivity, which is great. We've got almost the same amount of implied volatility sensitivity or Vega sensitivity this far out in time. Vega sensitivity, the impact of Vega this far out in time is pretty significant. Vega is one of those where that impact is greatest further out in time and less as we get closer to expiration. Because if we go to, so this is 108 days out to go until expiration. Take a look at that Vega, 54 cents of Vega, almost the same as our at the money delta. So it's almost as sensitive to that drop in implied volatility as it is to a dollar move in the underlying stock. But if we were to go back here to our, 1 or 2 or 6 days, let's take 6, because this is one of the options that has Monday, Wednesday, and Friday expirations. So if we were to go here to the 6 April expiration, look at what our 250 strike has now that we're close within that week to go until expiration. Much more theta, much less vega, and about the same delta. So delta sensitivity stayed about the same. Vega's been cut like by 80% roughly, and theta has gone up by about 50%. So, or more. So, I mean, this is how kind of that balance comes into play. So, as an option trader, you know, based on what your directional opinion is and how long you think it's going to take for the stock to make the move that it's going to make, you can go out this far and you're going to pay more for it. So, how do you mitigate this if you were to go out this far and mitigate that change? Now, let's pick one kind of halfway in this range. Let's go out to that one where we have the 1 May expiration, which is going to be right at that earnings announcement or right after that earnings announcement. And you can see that that theta or that vega number is cut by about half. Okay, cut by about half. Yeah, Thompson, we'll talk about Gamma Crush here in just a minute. But that being said, theta is cut by about half. So now we've reduced that theta sensitivity, even though theta in that case is higher and falling and likely to fall after that earnings announcement. So given the choice between these two, where I've got higher implied volatility sensitivity way out here to 108, and 108 days to go until expiration, and I've got lower theta sensitivity out here at 31 days to go until expiration, and I've gained not quite double the theta, and I've lost not quite half the vega, but my gamma, or excuse me, my delta is about the same. Given the two of those, and given the choice and the difference in that price by being about half the price, maybe a little bit less, I may consider going into that May 1 expiration, because it's going to be less expensive. It's going to be more capital efficient. I'm getting about the same delta sensitivity. I'm really getting half of the vega sensitivity. The only thing that's really changing there is I'm adding some theta sensitivity. So is that additional theta sensitivity, or avoiding that additional theta sensitivity, worth the potential to have much more significant vega if implied volatility is high and possibly falling, for just about double the price? And so given that, that's kind of the balance that those are the balls that we're juggling in the air here. So given those choices, especially if I thought that the stock was going to make a move quickly, I may be more inclined as a trader, carefully contemplating and being parsimonious, to Lara's point, about my option Greeks, to maybe go to the 31 days to go until expiration, because I'm not really getting that much bigger impact to theta. But if I were worried about that theta impact, what I could do is maybe even go a little bit deeper in the money. Now, deeper in the money is going to mean that delta sensitivity is going to be greater. So think about this. I was willing to pay $19.35 for this 108 days to go until expiration to get 9 cents theta. Now, I'm not going to get 9 cents theta here unless we were to go maybe, I don't know, let's see, 30 strikes. We're not going to get a 9 cent theta unless I go really deep in the money at 31 days to go until expiration, in which case I get a lot more delta and I get a lot less vega. So in thinking about that, I'm going to get a smaller percentage return. I've got to be willing to pay more for that option, but recognizing that that becomes less sensitive to those other things and more sensitive to the most unpredictable portion. Because remember, this is the theta is the most predictable, the vega second most predictable, and directional price movement the third most predictable, or least predictable out of the three. So I'm paying a lot of money to buy some some unpredictable response behavior. So that's where we might kind of come back again to the balance issue. So I might just simply say, look, I want to have some intrinsic value. I want to have a little bit of delta sensitivity. I might look at buying this at the money or very near the at the money strike. I might even come in for the same theta and just paying a little bit more, come into the 245 strike at 31 days to go until expiration, then going out to the 17 July, 108 days to go. Because if I start popping in here a little bit more, I still have that big Vega sensitivity. I don't have a lot of theta, a lot of time decay sensitivity, but I have a lot of Vega sensitivity, and there's a lot of time for Vega to crush. So given the choice between the two, as an option trader that, again, is looking for directional price movement, because that's the whole point of going long an option, I might go to that 245 strike at 31 days to go until expiration, rather than going longer dated and suffering from high implied volatility dropping because we got high IV. Now, if the IV were low in its range, that switches this scenario altogether because it's likely to rise. And then in that particular case, I want high IV sensitivity. If implied volatility were in the 25th percentile, legit 25th percentile, and very low and rising, a 54-cent Vega number may have some significant impact to my option premium. In fact, almost as much as delta in that case. So if implied volatility was low and rising, that might be the choice here. If implied volatility is high and falling, finding a strike that reduces that impact, by going to, like, say, the 245, might be the choice to make in that scenario. And again, not recommendations, simply considerations. And all we're doing is balancing all the forces at work. So I'm going to go ahead and I'm going to go long this one, the 245, and we'll see how this plays itself out. But that's based on this idea. Now, one other thing I'm going to talk about really quick, because Thompson asked about this. Okay. So what I'm going to do is I'm going to do this. I'm going to add one more Greek to our Greek set, delta, gamma, theta, Vega. And one of the things you notice here, 245, here we are, 31 days out to go until expiration, 1 cent of gamma. If I go to the one that is 100 days out to go until expiration, 1 cent of gamma significance. Not very significant at all. But I come down here to 6 to 10 days to go until expiration. Now that gamma starts getting bigger. Now, it's not bigger than theta. It's not bigger than Vega. Certainly not bigger than delta. But you get to 1 or 2 days to go until expiration. You can see that starts to get big. So what a gamma squeeze is that the closer we get to expiration, let me grab my magic marker to draw this out. The closer we get to expiration, what tends to happen is gamma widens out and gets steeper. It starts to look like this. That curve looks like this, with the price of that option premium kind of balanced right there. So if price of the stock goes up or goes down, that gamma crush or gamma squeeze happens because gamma manufactures or destroys deltas, and it does that to a great degree the closer we are to expiration. So one way to avoid all of this is buy the option and then look at selling the option at a point where gamma is not a factor. Don't hold it close to expiration as a long option trader. Don't hold it till expiration as a short option trader to avoid gamma as an issue. Now, for those of you that are zero DTE or short DTE traders, 1 or 2 or 0 days to go until expiration, that's a whole different ballgame. And we've got a couple of webcasts that talk about that. But this is kind of the process of figuring out, hey, what needs to be paid attention to? What are the forces at work? Okay. So we're going to go back to our 31 days to go until expiration. 1 strike in the money, a little bit more expensive, but we're willing to buy a bit more delta, a bit less gamma, about the same theta, and a couple of cents less Vega. for a little bit more intrinsic value and a little bit less extrinsic value. So a little bit more, that's where we get the higher delta. It's a little more sensitive to directional price movement. And I'm going to click on the bid price or the ask price here. And we're going to click on confirm and send. And we're going to read through this order. And we're going to say, all right, fine. Infinite maximum gain potential. What are we risking in the trade? $1,535. We're going to put this in our long option group. Before we do that, I'm going to kind of work this inside that bid ask spread a little bit. I'm going to see if we can get it a little bit less. I'm going to see if we can get it for $1 or for 15.30 instead of 15.35. In a live trading account, working inside that bid ask spread's probably an idea that's worth considering, simply because the market makers, they're actively working to give price improvement theoretically. Doing it in paper money may not help, because paper money is generally going to fill at the mid price or better. So we're going to go ahead and click on confirm and send. Once again, read through this, make sure that that's going in our long options group. Click on send. We'll fire that order off, and we got in at 15.20, which was well inside that bid ask spread, kind of working that order a little bit here in this particular case. All right. So now that we've got that long option in place, again, directionally, we're looking for price to move. We're looking to mitigate some of those changes. Let's go back to our monitor tab, because over the course of the last couple of weeks, we've put on a couple of trades that maybe needs some management here. As a matter of fact, I've got a couple that are probably getting very near that level of managing. So I talked a little bit about this, I think, last week. This is a 1 May 116 call on Akamai. AKAM is the symbol. The price of the underlying stock is at 114. We've got the 116 call. That call option is still out of the money. Here we are, 31 days to go until expiration. We bought it for $8. It's now lost about $2.50. So it's gone against us. It's working today, but let's go to the trade tab and let's take a look at that strike and expiration, and let's see where our sensitivities lie for this one. Because it's not just as simple as saying, well, it's lost money or it's gained money. All right, we've got to kind of see where our sensitivities are now that we are about 31 days to go until expiration. 50-cent delta, so it's kind of a coin toss when it comes to directional price movement. The gamma is a little bit higher here. Remember, each individual stock and each individual strike, they're going to have their own gammas. The theta here is not huge. We're talking about roughly the same price stock almost, but as what we were looking at with Apple, in fact, even a little bit less, but we're talking about greater sensitivities, right? That's the function of overall volatility and in each option and each stock having its own characteristics. That what's right for one is not necessarily right for another. So we've got 13 cents of implied volatility sensitivity. We've got 10 cents of theta sensitivity. Let's go to the chart for Akamai. So Akamai is continuing to move higher. That's our expectation. Implied volatility is rising. We've got an earnings announcement over the horizon, and we've got some momentum indicating some upward possible movement here. What's kind of hurt us a little bit in the short term is this little bit of a pullback, but we're getting a bit of a bounce there. So from a directional opinion standpoint, from a volatility standpoint, from a momentum standpoint, that's still working in our favor. What's working against us, and what's going to be working against us pretty quickly here, is this theta number, that time decay, because as we start to get a little deeper towards expiration, you can start to see what that theta at the 116, what that theta number starts to do. That theta number starts to kick up a little bit. But here's the thing. It's out of the money right now. And an out of the money option, the closer we get to expiration, tends to stall when it comes to that theta component. It tends to not increase that theta. In fact, it tends to sometimes even go the other direction. So we don't want this to stay out of the money, but at the moment, that's not really hurting us that much. So as a trader, looking at leaving this on with that potential for price movement to move to the upside, moving another 6 cents higher in terms of theta is not that big a deal, especially if we get a delta bump if price moves higher. So we may leave that one in place in terms of managing it. Now, as we get down to 20 days, maybe in the next 10 days or so, we may look at rolling that out. Now, here's CPB, 45 days to go until expiration. It's doing exactly what we expect it to do in this particular case, move it in the direction that we want it to go. And we'll take a look at a couple of these others. 17 days to go in this EXPE trade. We paid $19.35. It's now trading at $3.62. I don't even have to look at this in this case. I know that that's losing, and I'm kind of getting behind that power curve a little bit here. So I'm just going to look at closing this one down. So I'm going to create a closing order and just sell that one. And then I may come back and reevaluate. I could roll it, but I'm just going to close this one down in the interest of time and eliminate that loss and reclaim or salvage whatever I can salvage in that trade. Let's take a look at these other two really quickly. GEV doing just about the same thing. 17 days to go until expiration. That may be the one that we would consider rolling if our directional expectation is the same. Nike, with an earnings announcement overhead or over the horizon, doing what we expect it to do. It's going in the direction that we expect it to go. It's gaining since we entered the trade, so we're going to leave that one in place. Now here's another one where we're 17 days to go until expiration. Long put option. We're expecting directional price movement to the downside. Let's just take a look at the chart really quick. TGT. And target's moving up. Implied volatility is moving down. Both of those factors working against us. So this is one where, in this particular case, it's already lost some of its value. I'm just going to look at closing this out and reevaluating. Sometimes traders just have to be willing to take a small loss to potentially avoid taking a larger loss. And that's kind of the nature of long option trading, is being dynamic. Long option trading, because it is speculative, because the biggest factor and influence on the directional option trade is the directional price movement of the underlying stock, you have to be nimble as a long option trader. It cannot be a set it and forget it, let's let time work its thing type of trade. If it's doing what you expect it to do, it's doing it quickly, and it's doing it before time decay really starts to accelerate, then that may be a consideration for leaving a trade on. If it doesn't do that, think about the possibility of taking the trade off and reevaluating the situation and re-entering either another symbol, like some of you have mentioned, or waiting for another time where it is more opportune to get into that particular trade. So with that said, a couple of quick resources. Pop back over here to the youtube.com/@TraderTalks webcast page. I've already typed it in for you, Theta, and here's a great webcast option, Greeks for beginners, Delta, Gamma, Theta, and Vega, and even Rho. And then I talk about it, the importance of Theta and getting started with options. And then you've got a bunch of other webcasts that talk about time decay and its impacts. And then if you want to join us live, I'll just mention this. We are going to be in Dallas, not this weekend, but the weekend following, doing our Advanced Options Strategies Workshop. Come and join us there if you're in the area. Then we're going to be someplace we haven't been since 2018, when I happened to have fallen off the stage. It was a fun time for those that were there. We're going to be back in Boston, April 17th and 18th, doing technical analysis and option strategy. We'd love to see you all there. My thanks to Kevin Horner for helping out and for keeping that chat going and answering those questions.